Hello, this is Mr. Hatton, and today we're going to be talking about stocks, bonds, and other investment tools that you can use to make money over time. So the first question that we have is, what is a stock? And stocks are shares of ownership in a company. So what this means, and if you think back to when we've talked about types of business ownership, corporations are businesses that are owned by shareholders, usually many people that own a very, very small piece of a company, and those are called shareholders. And so it's kind of deductive. We can figure it out by that definition, but shareholders by definition are people who own stocks. And so what this means is that anybody can become a shareholder of a publicly traded company by simply buying a share. Now remember, it may be cool to be a part owner of Nike, but your share is going to be a very, very small piece of the company if you just buy one. One out of hundreds of million shares, more than likely, depending on how many shares the company has been split into. So why would people be willing to pay money for stocks? And the real idea behind this, if in our previous video we looked at the fact that compound interest is what allows you to make money over time and allow your money to work for you, that's the idea behind stocks. If you remember, we said that when we were looking to invest, what we want to do is be able to make money over time and have our money work for us. And stocks are the best way to do that. So if you're looking for that 6 to 10% return, stocks are one of the best places that you can put your money to really allow it to work for you. And so the question to why stocks is to make money grow. If you were to just leave your money in a bank account, especially like a checking account or just a regular savings account, you are going to make an extremely small amount of money off of your investment. You're really allowing the bank to use your money for free because you're putting the money in the bank, but then you're not actually getting anything from it. You might even be just getting a fraction of 1% from your money if you just leave it in a regular bank account, a regular checking account. So stocks, on the other hand, they're actually buying something. You're using your money to fund a company, but you're actually getting a piece of that company in return. And so when you buy a stock, you are a very, very small owner, but then you're going to share the profits of that company with them, scaled down to the degree of how many stocks that you own. But aside from just being able to make money by owning a share of stock, because you actually are a partial owner, you also get some other privileges. Usually, depending on the class of stock that you buy, you get the right to vote. So the right to vote. And what this means is that when the company is making decisions or electing a board of directors, that each share of stock is going to get a vote. Now, before you start thinking that, well, you're going to be able to tell Nike what you want to come from their next line of shoes, you need to understand that really unless you own an extremely large portion of a company, your vote is probably not going to matter, but you do have a right to cast it. Usually companies are going to hold on to a voting majority of their company to where individual stockholders can't actually make a change because they would still have enough votes to overrule you, but you would get a right to vote in that company. They're going to have to send you information about stockholder meetings, and even if you just own one share of that company, you do get a right to cast a vote, whether or not it actually gets counted in what they're going to do with their decision making. The next term that you need to know is the term stock market if you're thinking about investment. And just like the term suggests, the stock market is a market where you can buy stocks, but it's usually done online or through a broker who's actually going to be at one of the major stock markets casting those, making those trades for you. And so a stock market is just going to be a place where people can buy and sell stock. So it's a place where people are going to be able to buy and sell stock, and so it's going to be on a publicly available trade or available market where you can see the cost of each individual stock. You can see what a bid is, what an asking price is, and the stock market really functions like a big scale auction, but to where there's not one auctioneer who's auctioning off a thing at a time, but to where you have hundreds or even thousands of people who are all trying to buy and sell at the same time. And so those offers are mixed with each other. The buyers get to buy what they want, the sellers get to sell what they want, and then they meet at a price called the equilibrium point. That's where they're going to decide on that point. Now, the price of a stock can change 100 or 1,000 times over the course of a day, but they're eventually going to settle on one price for that stock, even though it might change throughout the day. So what are some advantages of the stock market over others? And the biggest is going to be what we actually already talked about earlier, is that stocks outperform. They outperform other investments. Now, each stock is going to have its individual risk that we'll talk about in a moment, but as in general, if you want to make a decent return on investment, if you want your money to work the most for you, investing in a business allows that money to grow exponentially, especially if you're willing to invest it for a certain amount of time. Another advantage is that stockholders can vote. Voting rights. You get to say what you want the company to do, and whether or not it makes the ultimate difference, you do get to have a say in what happens with the company as your money is being invested. However, just as with most things in life, there are some disadvantages to stocks. And the biggest being, and the biggest disadvantage over putting your money in a bank, is that stock prices they go up and down. Whereas if you put your money in a checking account, if you have $100 today, you're going to have $100 tomorrow. And when they give you the investment, you might have $100.02 at the end of a year. But they're going to be relatively the same. With stocks, however, unfortunately, this is not the case. The stock market, as you'll see in a moment, goes up and down constantly. And so when the stock market is down, if you needed your money right away and the stock market has gone down, you actually have the potential to lose money. And that takes us to the second disadvantage, which is that the stockholders could actually lose their money. So stockholders could lose their investment. While you hope that this is not the case, this is why it's going to be important to make smart trades, is that a stockholder could potentially lose their investment in the stock market. If you had invested in a company like Circuit City that went out of business a few years ago, you would have actually lost all of your money because your stock would have become worthless. And that when that company started declining and ultimately went out of business, if you were the one that was kind of caught holding the bag, you would be there and you would now have nothing left for your investment. That stock is now worth zero. When the creditors take over, stockholders are among the last to be paid by creditors. And so it is possible that a stockholder could lose their investment if that company goes under, or even if they don't go completely under and go out of business, if your stock decreased to a certain price, then you could lose money if you chose to sell it. So these two disadvantages, that stock prices go up and down, that you can lose your investment, they go hand in hand. If your stock decreases in value for a short term, as long as you don't sell your stocks, you're still going to have the same number of shares, but that the value would go down. And historically, that as long as there's not a fundamental issue with a company, that even though the price may go down temporarily, it's probably going to go back up. And so there are some ways that investors will often talk about describing a market as a whole. And there are two types of markets that they may describe. And so what they mean is that they're not separate stock markets. They mean that that's a description of what is the stock market currently doing. And so the first is going to be called a bull market. And if you hear someone talk about that they believe that the market is in a bull market, what they mean is that stock prices are rising and people are optimistic. People are happy about the way things are going. They think that the market's going to keep making money. And this mindset actually fuels upon itself. That because people think that it's happy, everybody's getting what they want, their money is making more money, they're actually usually more likely to risk more. And so you see more trades happening. You see a lot of people going forward, a lot of people being willing to invest in these companies. It's a good time for companies because when people invest, if they're selling stocks, they can use that to raise money for their business. It's good for their shareholders so that if you remember that shareholders get a chance to vote, people are happy. They're not going to vote out the board of directors. People aren't going to get fired. And the company is going to make more money because they're able to get more money to invest in other projects. The opposite of that is called a bear market. And as you might expect, this is when stock prices are falling. People are worried about what's going to happen, and so we would say that people or customers are pessimistic. Well, which pessimistic just means that they don't have a positive outlook on how things are going. They're not happy about the way the stocks are performing. They're going to be more afraid to risk their money. They're not going to buy stocks because they feel like that their stocks are just going to lose money. They might be seeing it happening if they're checking their portfolios. They can see that the price is going down, and so they're going to be reluctant to buy. And just like a bull market can kind of build upon itself and lead to more investments, which can lead to companies making more money, a bear market can do the same thing and can be hard to snap out of because people are afraid, they're not going to invest as much. If the companies are trying to raise new money by selling new shares of stock, they're not going to be able to make as much money, and that might make it harder to fund new projects. This is when your board of directors might start getting nervous because if the stockholders are going to vote, they might choose a new direction or be afraid of the way that a company is going. And so companies are really afraid of a bear market. So if we think about a bear might be scary, we want to avoid that. And then the bull market, which is the positive side, might think about that. A bull charges forward, it leaps up, and so we can see that as gaining momentum. It's a positive thing. It's going forward, and so that would be the difference between a bull market and a bear market. So to sum up this lesson, we would say that stocks are investments. They allow your money to increase over time, and you actually become an owner. So if you want to tell your friends that you're an owner of Nike, go out and you can buy a share of stock. As long as you have a brokerage account with a bank or another organization that can buy stocks, you can become a part owner of a company for not that much, and you can actually share in those profits. Just know that your profits are going to be scaled over time so that the amount of your profit is going to depend on the amount that you have invested. But if you want to become a millionaire someday and you want to allow your money to work for you, stocks are probably going to be your friend, and it's probably going to be something that you want to work with for a future. So embrace stocks. We're going to learn more about these in the lessons to come, and so that stocks are going to be a very useful tool for financial investors.